Hey traders, welcome to Charts and Coffee. Hope everyone's having a great morning. It's not been one without its fireworks. We're taking a look at the post PPI and initial claims environment. We've got a PPI number, created some first come, first serve volatility on the hourly price movement ranges, time and volatility doing its thing. You can see the range that everything is basically surrounded by, and that's what our expected movement for an event. If it's going to work within its historical volatility, its high to average area, you can see exactly what we've got here. So those of you with the HPMRs trading that very early first U.S. day trading window. This was the first high impact hot zone of the morning, and this gives us that first come first serve. This gives us that whichever end of the hourly price movement range we reach. Well, is that the first one we want to take? Well, let me tell you a little something about how we set this up. In terms of overall sentiment, and it doesn't take a lot to realize this market's in an overall bad mood. The path of least resistance on a 5-minute chart, the path of least resistance on the daily is definitely pointing to the downside. So if you join me for June's hot zone sessions, and we'll be doing those again for sure. We'll get a schedule out for a few more of those live streams. But if you join me for any of those June hot zone sessions, whether that be non-farm payroll, PCE, CPI, same idea. Pick a side. Know that there is usually, from a probabilistic standpoint, that mindset, there's usually a way the market's going to be moving more likely than not. And that's part of the day trading process, gang. That's definitely something that I teach and that I use, that there is a path of least resistance, and that's the way we want to favor our trade. So the first thing we looked at today was a short, looking at that opportunity in this range that is pre-identified before the hot zone. So this will sit there as long as we don't put in a lower low than what we did at 805. So once that lower low is put in, that resistance zone just sits there. Place a limit order, place an alert. It's there static waiting to see if price gets up there. So that's the first thing that we did. Already hit the first target at 37.52 and a half. And now sort of we hit the reset button, right? Now we want to do what? Now we want to hit the reset button and say, okay, what's the next setup? Not sort of a mix of what did I just do and can I do that again? Fresh set of eyes, sort of clear the mechanism and start all over again. And by the way, that reminds me that tomorrow, gang, tomorrow is the very last day that you can grab the class where I teach all this and the indicator for a year, the updates for these zones, so they're accurate to the current volatility, just like that implied volatility is going to contract and expand. Same thing with hourly price movement range. They're going to have to look at a certain look back of volatility, and they're going to respond accordingly, and then we adjust the indicator to make sure we're getting the most accurate level. So tomorrow's the last day where you can get that bundle, and then after that, everything's separate. So I'm just mentioning it now. If you've been on the fence, now's the time to do it. All right, so as always, I like to give you a little bit of an idea of what I've got going on in the morning, and then let's just jump on into the questions. That is what this show is all about, after all. So great to see everybody. Absolutely. Happy Thursday. Got my my favorite little yoga mug this morning. Love this Yoda mug. Who doesn't love little baby Yoda? Yeah, I'm definitely in attack mode this morning. And then after that, I'm going to go into protect mode as we protect some profits on that first trade. All right, first up, hey there, MVC. Good morning. With the bad CPI data and now even more hawkish a Fed, why did the market rally yesterday off the open? Was it just exhaustion or something a little bit more sinister? Why did the market rally? It's interesting that the perception. So this is all a perception thing, right, MBC? The market rallied off a low, but yesterday was a down day, right? So look at it. Let's look at it this way. And I would say, generally speaking, if you are looking at the market from 9:30 to 4, you're getting a very skewed and incomplete, maybe incomplete's the better word, view of what really happened. So take a look at the daily candle from yesterday. To your point, here's the low, here's the high, right? This is the open, here's the close. Yesterday was a down day. So I don't look at yesterday as a day that was bullish. I think the idea that if we look at the action between 9:30 and 4, we get an idea of what is really happening is, again, it's an incomplete look. I don't look at yesterday's action at all as being bullish. When you mentioned it rallied off a low, still closed below the previous low. That's a bearish candle. So I guess my answer is why it did whatever it did. It, frankly, honestly, probably doesn't matter. As long as you keep in mind, we stayed below the previous close. We stayed below the previous high. There's just so many markers that say, while it didn't close near the lows, it closed bearishly. So I think my answer to that question is, how are you measuring a market rally, right? Are you looking at yesterday's candle as bullish? Because then that's where you and I have a very different view. And not because one is right and one is wrong. One is based on one open, high, low, closed view, 9:30 to 4. And the other is based on the fact that S&P futures, more so than the SPY, more so than the SPX, are viewing a more complete view of market actions. I hope that makes sense. An awesome question. I like what you asked, because it really does emphasize why we, as traders and investors, sometimes have very different views of what happened. And oftentimes it's going to be, what's the time horizon? What's the time frame? And in this case, what's the instrument? SPY, ES, very different perspective. And take a look at SPY. You can see, look at SPY. It looks a lot more bullish, right? That's a light red candle that indicates we closed higher, right? If I'm looking at SPY, I've got a very different view, don't I? So if you're trying to understand what indices are doing, even if you want to trade the SPY, even if you want to trade the SPX, those of you that just took the day trading class, and you still can, by the way, we have all the replays, all the live sessions recorded. You'll see that that's not the line in the sand. That's not where we say, okay, this is point A. Where do we end at point B? So very cool question. Battlehawk, how are you? Question about XOM. Sure. And the CCI, MACD, and stochastic trade flags. CCI is pointing up on XOM. Not really. Slow Stow is at 19. That's oversold. And MACD is looking to cross. We don't use all three, Battlehawk. The only reason I have the flag, so for those who don't know what this tool is, I don't want a bunch of stuff. A lot of folks might have 2 and 3 and 4 indicators down in this area. And what that does is it scrunches price to a very narrow area in the chart that we're looking at. So in an effort to save space, this was something that was created in order to not have to use all that valuable real estate for a 20-period CCI, for a 12-26-9 MACD, and for a 21-3 slow stochastic. We save space by just turning them into labels. Each label isn't used together, right? Each one has a job. CCI is a great one to understand momentum in the context of a trend reversal. MACD is a great one to understand momentum. And stochastic is overbought, oversold. So we don't look at them together, right? We look at them, why would I consider each? And so that their job is to just make it much more compact to track 3, rather space-taking up indicators and putting them in the chart. So that is not how we want to use that ever. We want to start always with structure. Structure is determined not by the secret squiggles of the CCI, MACD, or slow stochastic. Structure is determined by the momentum trend trade flag. Structure is determined by the red, the blue, the green grab candles. Structure is determined by, even better, the multi-trend. So once we get those tools, you can use the wave, right, which is part of the grab candles. Once we determine structure via the trade flags, the Momo and the trend, or the grab and the wave. And by the way, if you are a member of any of the main rooms over at Simpler, you can download the grab, the wave, and those trade flags and put them on your chart so you can start with structure too. And then you can migrate on to whichever secret squiggle is going to take you to, how do I trade this trend? How do I trade this chop? Am I waiting for a breakout breakdown? I mean, those are three basic categories of indicators. So everyone out there, if you're not already crystal clear on which one your indicator is best designed for, that's some valuable homework. I can't promise much in terms of, oh, do this and you're going to be a winner. I can promise that. If you use your indicators in the right environment more consistently, your trading is inevitably going to be more productive because, you're, to use a golf analogy, you're heading up over to the tee. You're not grabbing your putter, you're grabbing your driver, right? It's just making sure you have the right tool for what it is you want to accomplish. And that's always going to be a needle mover. So that's how we use those indicators. This is not specific to Exxon. By the way, Exxon is in chop. Exxon's in a choppy market. So which one of these three would I use? I'd keep an eye on that stochastic. All right, next up, Tim asks, new Sector Secrets Mastery member. Very cool. Welcome to the think tank. Can I talk a bit about and show an example of gap, fades, and breaches? That's an intraday setup, Tim. It's really hard to recreate those kinds of things, especially an intraday situation. But let's talk about at least the terminology. So a gap fade. All right, we get a gap. All right, and we are today. We're going to get a gap. There's two kinds of gaps. There are what I just kind of call a vanilla gap, and there are true gaps. Vanilla gap is we closed at X, and the next morning we opened, above it or below that close. That's a vanilla gap. Hey, puppy, I'll let you out in a minute. Just chill. And the pup's in the office today. I don't think he's here wandering around. And then a true gap, I believe that's more market profile parlance, is we've opened or closed, open above the previous session high or open below the previous session low. So it's a more exaggerated psychology, and this is going to be a true gap. So it's a more exaggerated gap down. Now you're going to see the gap. You're not going to see the gap on the S&P. You'll see it on the SPY. You'll see it on the sectors that are weighted within the SPY. You'll see it in individual stocks. So remember, gaps are visible when we have these distinct opens and closes. You can see them on futures from time to time, but usually not very much because the closes are so small. The longest period of time the S&P closes Sunday evening through Friday is the longest period of time at one stretch is an hour. So gaps aren't as visible on there. But this will be a gap open, not by much, but it will be a true gap open by a little bit. It's clearly a gap. The fade on a gap down is traders looking to buy weakness. Now, there is an illogical sort of setup that runs through trading. Everybody does it. Probably happened in crude the other day. What happens in crude? We sell off like crazy. And by the way, I'm long crude, but not from this big red candle. We're long crude from basically around 95. So if we're sitting at 95.57, not 95, 93.57, that's not a lot of heat. But what a lot of traders do is they see a big sell-off and say, I'm going to buy into that. That's not a setup, is it? Just the idea that, it's gone so far, it has to bounce, is just a ridiculous logic for anything. So if something's gone up too high, if something's gone down too low, okay, that could be the beginning of a narrative. Then we need a setup. So it applies to gaps too, because, it's gone too far. Maybe, or maybe it's just gearing up to really go further. So a gap fade has a setup. It's the notion that there's an extreme psychology and there's likely to be traders thinking, hey, let's buy this, but we still need a confirmation. So that's a basic breakdown of the gap fades and breaches. And if you're with me in the Sector Secrets room, Tim, starting next week, we're going to have a day trading session where I can walk you through this live, and I'll be trading it with you live and making my calls that I'm taking live, the way that I took the trade in this morning. I'll be explaining different setups, 9:20 to 10:30. We're going to be doing that starting Monday. So you can watch it live and see the setup. So I think at that point, the gap fade, the breach retreats will make a lot more sense, because seeing them live, especially intraday setups, makes a lot more sense. But as long as we're on the same page now with some of the jargon and the psychology, Pop, give me a minute. As long as we're on the same page with some of the jargon when we start on Monday, if you're part of the Sector Secrets Mastery, buckle up. We're adding those day trading sessions to the Mastery. All right, give me 1 second. Let me see what this pup wants. All right, Pup. Usually the cat is a pain in the neck in the show. Now you are? All right, go on. All right. Usually she's such a good girl during the shows. All right. Next up is if I were to trade the VIX, Nick, my preference for VIX trading is the futures contract, VX. And then alternatively, what I'll do is I'll use VXX. And I believe the bot, for those of you that have the HPMR indicator and want to day trade the VIX, we are going to have the HPMRs, the hourly price movement ranges for the VXX, I believe, available already or in the next pack. And the newest HPMR pack, for those of you that took the class and or have the HPMR subscription, that newest pack is coming out, I believe, Monday. So we've updated it. We've had a bit of volatility, haven't we? And so we're going to update it with those fresh levels. And we're going to be starting with a new HPMR pack next week as we add those day trading sessions Monday through Friday to the Sector Secrets Mastery Room. Trading, really my favorite hour of the day, 9:20 to 10:30. 70 minutes, I know. But we'll be doing that. So yeah, I like VIX futures, but a lot of traders like to play the options on VXX. 6 of one, half dozen the other. Choose your own adventure. It's all good. But I track the VX futures, Nick. Great question. All right, next up, Frontman says, I get too wrapped up in my charts and find it challenging to know when to stop. How do you discipline yourself to take breaks, knowing when to step away from the charts during your trading day? So, Frontman, I will tell you this. I've got a buddy of mine. He has a chapter. It's one thing to write a book. I've written 3 of them, right? It's one thing to write a book. It's one thing to have a chapter or a book written about you. So this buddy of mine, I haven't seen him in a while, but we used to have coffee at Starbucks and catch up and stuff. And he's got a chapter in one of the Jack Schwager Wizards books. And he's the most active day trader I've ever known, watched, etc. And when I active, I'm talking 60, 70 round trips per day. Now you might think, oh my gosh, I mean, this broker must love him. And, he's returned almost $1 billion to clients. So he's a very, very, very good, super active day trader. Would I ever say that he's too wrapped up? No, he's super active. That would put me in the hospital in the span of a week. I consider myself the world's most boring day trader. All right, so I was fascinated by him because we were just a 180 from each other. But that activity, that intensity worked for him, right? So my test for too wrapped up or when that time spent in front of the monitor is negative, look at your P&L. Look at your P&L. If you're spending that much time in front of the charts and it's affecting your health negatively, it's probably affecting your P&L, or vice versa. Negative P&Ls can affect your health too. Don't we know that as traders? If you're not getting the results you want, this is where you have to, the discipline is what I'm doing working or not working? Trish has a great line and she delivers it better than anyone I know. And for those of you that know Trish, she's my partner here in the office. Anything that I do well, that was her brainchild. Now, she has this thing that she does from time to time. And I'll say, I'm doing this. And she'll look at me, she'll raise an eyebrow, and she'll say, and how's that working for you? All right? But it's true. So I'm going to do that. Frontman, how's that working for you? Now, if you're like my buddy and it's working great, find a way to take a break so your time spent in front of the computer is your best most, inflow self. But if it's not working for you, what else do you need to know? Doing more of that is not going to get you where you want to go. And that's what I do to self-regulate. How's that working for you? Right. And it's a little tough medicine sometimes, but it's true. I hope that helps because I think we've all been there. And I hope that helps. The last question here, and it's an important one. I'm going to dive into that. Am I still looking for a potentially oversold crude oil market? At this point, Dave, what I'm going to do with USO, we have USO calls, right? What I'm going to do with USO calls is I know where my validity is on this, and I'm not going to worry about what CL or USO is doing until 10 o'clock Eastern. Let's get past the clearing range. That's number one. After that, we know what our paper cut is. We have a paper cut percentage-based stop, or we have our point of validity, more price/technical based stop. I won't even consider that technical based stop till after 10 a.m., after the clearing, and we can operate with a paper cut, meaning we already have a predetermined, a known amount of risk attached to this trade. And if that level hits, it's never personal. We move on, right? We have some monster trades going on in XLC and XLF, and those will continue to produce. So why would I let one trade outdo the good trades that are working? I cut this one as I have to, so it's a small risk, and I let the stuff that's working, like our XLF put, which is going to be fantastic this morning, keep going, right? And then in the meanwhile, we're also day trading. So we've actually we'll see how it goes this morning, we had 3 positive day trading days in a row. So we're going to keep moving forward with that. So let's see if we can't put that fourth in there. And that's the way I'll balance that out. All right, gang. I will see you all tomorrow, same time, same station. In the meanwhile, be good to each other. We have rocky, hot zone, heavy days. Tomorrow's retail sales. All right. I'll talk with you soon.